Hello and welcome to today's presentation on depositories and regulators. In today's session, we will learn about depositories and regulators. DMAT or dematerialization is the move from physical certificates to electronic bookkeeping. In the age of computers and the depository trust company, securities no longer need to be in certificate form. They can be registered and transferred electronically. The bonus or right shares allotted to the investor will be immediately credited to his account rather than posting him physical certificates. Dematerialization helps make the circulation of securities more easy and liquid. Transfer of shares can take place electronically rather than issuing new physical copies. Depository is a specialized financial organization holding securities such as shares in either certificate or dematerialized form. The goal is easy transfer of ownership through a book entry rather than the transfer of physical certificates. Suppose an investor wants to sell his shares and has placed an order which has been successfully executed on the exchange. It is the depository's responsibility to change the ownership on the share certificate, whether physical or in dematerialized format. The depository system functions very much like the banking system. A bank holds funds in accounts, whereas depository holds securities in accounts for its clients. A bank transfers funds between accounts, whereas a depository transfers securities between accounts. In both systems, the transfer of funds and securities happens without the actual handling of funds and securities. Both the banks and the depository are accountable for the safe keeping of funds and securities respectively. The diagram explains this process very swiftly. The sell order is placed by investors and the same is executed on the exchange. Securities are maintained at a centralized location, that is the depository, and are then transferred in the name of new owners to reflect the change. Concentrating on the Indian markets, we have NSDL, which is National Securities Depositories Limited, which was established in 1995. It was created to handle most types of securities and to settle trades in dematerialized form. It is said to have more than 1 crore 31 lakh investor accounts with more than 12,000 companies whose shares have been dematted. CDSL is the second Indian Central Securities Depository. CDSL received its certificates of commencement of business from SEBI in February 1999. Its main function is to hold securities either in certificated or uncertificated form, which is a dematerialized form, which enables book entry transfer of securities. In this table, you can see the securities held by CDSL in financial years 2013 and 2014, along with the composition of the securities. CDSL held 5.76% more equity shares in 2014 as compared to 2013, and 5.25% more debt instruments. However, its holding of other securities, which formed a higher composition than both equity and debt combined, fell down by 0.07%, leading to a total increase in relatively modest 2.41% increase in the total securities held by CDSL in financial year 2014, which comes to 32,800, compared to financial year 2013, in which it was 32,028. The major functions of regulators are to register listed securities, to register stock exchanges and dealing members, to set the rules and regulations and ensure compliance of stock exchanging and dealing members, to monitor the market and prevent insider abuse, to resolve disputes between parties, to license dealing members, to list requirements for issuers of securities, and to facilitate the secondary trading of securities. Here, we take a look at a well-known Indian regulator, the Securities and Exchange Board of India, or commonly known as SEBI. SEBI is a centrally controlled body that is entrusted with the task of protecting the interest of investors in securities and promoting the growth of the security market by implementing appropriate rules and regulations. It was officially established by the Government of India in the year 1992, and since its inception, SEBI has regulated the primary market, secondary market, mutual funds, and foreign institutional investments. Some of the most important functions of SEBI is to regulate the Indian market. Some of the most important functions of SEBI to regulate the Indian market are listed on the screen. These include regulating the business in stock exchanges and any other security market like bonds, pension, insurance, registering and regulating the working of intermediaries, and player in security market. Registering and regulating the working of collective investment schemes like mutual funds. Prohibiting fraudulent activities in the security market. Prohibiting insider trading in securities. Stabilizing prices. Promoting investors' education. Inspecting and inquiries on regular basis. Regulating substantial acquisition of shares and takeovers. Levying fees and other charges. And conducting research. RBI is the central bank of the country. It was established in April 1935 with a share capital of 5 crores on the recommendation of the Hilton-Young Commission. The share capital was divided into shares of rupees 100 each, fully paid, which was entirely owned by the private shareholders in the beginning. The government held shares of nominal value of 2,20,000 rupees on 3rd December 2013. RBI undertakes the following. It regulates issue of banknotes, maintains liquidity along with acceptable inflation rates, creates additional securities and absorbs surplus money from market. RBI buys dollars and creates additional money. Buys government securities and infuses money in the market. Regulates foreign exchange transactions. Being the apex financial body, it regulates FDI, FII, mutual funds, pension funds, and monitors functioning of SEBI. Strengthens investor protection mechanism and provides efficient legislative framework for securities market. Forward Markets Commission FMC, headquartered at Mumbai, is a regulatory authority overseen by the Ministry of Consumer Affairs, Food and Public Distribution, Government of India. It is a statutory body set up in 1953 under the Forwards Contract Regulation Act 1952. This commission allows commodity trading in 22 exchanges in India, out of which 3 are national level. As of July 2014, it regulated 17 trillion rupees worth of commodity trades in India. In September 2013, the Commission's responsibility was moved to the Ministry of Finance to reflect that futures trading was becoming more and more of a financial activity. With this, we end today's session. We hope you enjoyed it. Thank you.